Welcome, ladies and gentlemen. I'd like to welcome you to our investor update. I'm your host, Dan Theok, Senior Vice President of Investment Banking here at Mayberry Investments Limited. You guys will be familiar with investment advisor Justin Scott. He's always a welcome addition to the platform. Welcome, Justin.
Glad to be here, Dan.
Great to have you. Today, we'll be bringing you an investor update on Palace Amusements Jamaica and PanJam Limited. If you're a fan of the content, remember to subscribe to our Mayberry YouTube channel. Hit the bell to receive all notifications. We upload content like this every week. Before we get started, I'd like to take this moment to remind you that if you're looking to expand your portfolio or embark on your very first investment journey, Mayberry can place you on track to financial freedom. Follow us on social media at Mayberry INVJA to learn more. First up, we're going to present on PanJam Investments Limited. Now, PanJam's definitely one of my top 10 favorites. It's a great company with great potential, and you have to look at this one as a medium to long-term investment company and not get always distracted by the quarterly short-term results. Here we see in the 6 months ended June 2022, where the actual financial performance was less than the prior year, primarily as a result of the investment gains in their investment portfolio of equities, where we see an actual $43 million fall in their investment portfolio in this 6-month period compared to the prior 6-month period where they had a $1 billion gain. For context, the prior 6-month period is when the stock market was coming back up out of the pandemic. And here in the midst of the increasing and rising interest rates, PanJam's actually seen about a 6% fall in their investment portfolio. But again, this is a $9 billion portfolio of equities, which they're holding for the long run, which is why, again, I say let's not get excited by the quarterly movements necessarily. This is a great company with great potential. In addition, they have property rental income, and that's usually about half of the income of the business if you looked at last year. And that property rental income was relatively flat at $1 billion. They have over $10 billion in investment properties. And we expect to see this income growing because we know that they just literally opened in July their Rock Hotel in downtown Kingston, which has 168 rooms. And we're really expecting to see good rental income or property income coming out of that property. And I say kudos to Stephen and Joanna for making that investment in Kingston, Jamaica. I really look forward to seeing downtown Kingston in particular coming back, and we see property values going down there substantially. So great to see PanJam well positioned down there and supporting the hotel sector space in that environment. Moving along, we see operating expenses increasing by 30%. Mainly because of the increase in staff costs associated with staffing up for ROK Hotel, they tell us. We see finance costs relatively flat, small increase there. The gain from associate was really $1.8 billion relative to $1.54 billion, up by 17%, and that's driven by the income from Sagicor. That line item's missing. I apologize for that. And I want to remind you guys again that PanJam owns a 30% stake in Sagicor. And I'll talk a little bit about that as we go on. Net profit attributable to shareholders, therefore, was down by 50% to $1.1 billion. So was the EPS. But when you look at it, the stock, even at 56.86, is still trading at a 10 times PE ratio. So it's still relatively cheap. Main market average today is about 10, but I like to think of it as about 12 times. And more importantly, I have no doubt that the earnings of PanJam are going to come back strong as interest rates level off. The market's perception as to whether rates are going to keep increasing goes away in the next 6 to 9 months, I would say, and the PE ratios of the market return back to 12 times. That's going to happen, guys, in the next 6 to 12 months. And so as PanJam's earnings improve, because they just hit a little bump, and as the PE ratios improve, I'm going to predict this stock in a year's time is going to be closer to $80. It's a stock that's been as high as $100. So this is really a relative low at 56 for the last 3 years. As far as I can recall, this is a pretty good low. And I think it's a great time to think about buying the stock. Let me tell you 2 additional reasons why. They have over $64 billion in assets. $32 billion of those assets represent their investment in Sagicor, which is listed on the stock exchange at the carrying cost, not at the market value. They don't mark that to market. They don't mark the market on that because it's a 30% stake. If they were to market, that $32 billion investment is worth $68 billion. So they're sitting down potentially on a $36 billion gain. That's eventually going to come into the balance sheet one way or the other, I promise you. But in the meantime, what we can expect are good things like dividends. They paid over $1.2 billion in dividends for the half year. And so it's a great company, fairly well diversified in terms of the property portfolio. Little bit of concentration risk on Sagicor, but I think it's a good bet. And the fact that they're carrying it at carrying value and not at market value shows the conservatism in the way they present their accounts. Again, if they just sell 5% of the Sagicor stock, they could bring in $10 billion of cash. So there's a lot of potential. It's a business. Although the assets are listed at $60 billion, it's understated by about $30 billion relative to the market value of their investments, which is a good thing. And that's why I think Sagicor is a good one. That's why I think PanJam is a good one to have in your portfolio. You can't really read PanJam without looking into Sagicor, but I assure you Sagicor is rock solid. Next two slides pretty quickly just shows the quarterly performance. And again, this last quarter, $108 million is really down again because of the mark-to-market on the $10 billion of investments that they have that are traded. But again, as I said to you, we think that's just very temporary. We've seen the results in the last 7-8 quarters looking pretty strong. They had some challenges in Q1 and Q2 of 2020 at the start of the pandemic. They very quickly sort of brushed that off and have gotten into a nice rhythm. And what we see here is the last 2 quarters just being a little bit lower than expected, but again, primarily because of what's happening in the market. And I do think that's going to correct in the next 6 to 9 months, and we'll see PanJam back onto $1.5 to $2 billion profitability per quarter. The stock price could easily be at $80 in the next year. Last slide looks at the stock price and shows how it's been sort of relatively flat for the last 24 months, sort of peaking at maybe just about $74 in the last 24 months. But again, as I said, this is a stock that's been as high as $90 2-3 years ago. I think it has the potential to get back to $90 perhaps in the next 2 years or so. And so it's a great buy at $60 or lower, and you have patience to wait, 12, 18, 24 months. Great one for the long term. Very well positioned, very strong in their investment portfolio. They own lots of assets, commercial real estate in particular. They have over $1.2 billion in property under development as we speak, even having just finished the ROK Hotel. So it's great to see a company like this on a stock exchange that's not just tied to services. Perhaps their 50% investment, their 30% investment in Sagicor, yes, that's tied to financial services. But on the other side of the fence, they're making huge investments in commercial real estate, lots of property rentals, good, strong property rental income. Definitely a good one to have in your portfolio. Justin, what are your thoughts?
Thanks, Dan. I think you pretty much touched on just about everything there. But yeah, PanJam is definitely a giant in the market as it is. It's definitely going to be a favorite for those who are fundamental investors, those who are willing to invest over the long term in time, especially for those who really look towards ratios as a reason to really support them, right? The PE ratio of about 10 times or a book value per share of about 48 times. People who really look towards that, whether it be financial institutions or people who have that kind of timeline on them, should definitely be attracted to PanJam right now as it is with the price of $56, right? As I said, very much heavy into their real estate portfolio, whether it be commercial real estate or otherwise. Very heavy into other private equity investments. Some of the companies that you mentioned they own about 30% of Sagicor Group Jamaica, right? Not SFC, it's Sagicor right. Group Jamaica. Right. They also own some of Chukka, as well as Nutsford holding companies, and as you said recently, Rock Hotel. So they definitely do have an eye for the investments that they make. And even despite having erased basically $1 billion off the income line from their investments for the most recent financial report we just looked at, they really have been strong without it, just as you would have seen earlier. And so, once things start to turn around a bit more, as people start to return into the equity investment market, we should definitely be seeing a lot more developments from PanJam.
Absolutely. And again, for the large financial institutions or the large institutional investors, rather, there are like 3 stocks out there that I think you have to be focused on because they have good liquidity and relatively low PEs and great potential for growth. And it's got to be PanJam's got to be one of them. JMB's got to be a second one, and I think NCP is your third. So definitely my three best buys for large institutional investors. You want to write a check for 10 million, 20 million, $30 million. You can buy 10, 20, 30 million of these three stocks easily, and they trade with great liquidity. Well, great. Thanks. Appreciate that. Next up, we want to look at Palace Amusement Company Limited. What do you have for us, Justin?
Okay, great. So Palace Amusement Company is a very nostalgic company for me, especially. I know a lot of you viewers would have been growing up in Jamaica at the time, taking the time out with the parents or otherwise and going out to actually watching the movies, right? So Palace Amusement, as you may know, they're a theater company. They have three main lines of businesses, being cinema activities, the theater operations, as well as their confectionery stand where they sell the food, film activities where they purchase or rent film properties, which they then would distribute to other film operators and distributors in the island as well as within the region. I'll get back to that later, as well as advertising. You've seen all the ads, right? So Palace has actually been having a pretty rough time over the last couple of years. I'm sure you can understand why, where revenues actually, well, over the recent time, especially since coming out of the global situation, the people have been a bit stir crazy. People have been locked up inside for quite some time, and they were really excited to go out and participate more. So you can see that represented in the gain in revenues there, moving from 105 million over to 649 million. However, as that related to the profit lines, no, not so much. As you can see, direct expenses would have increased quite a bit more, resulting in a gross loss of about negative $57 million. And then you have admin expenses on top of that. You have financial costs on top of that. So you really, they've really been going through a rough time now, as you can see from the losses. They currently don't have a PE ratio, as without a proper system of earnings, they can't really track the PE properly, right? But as it is, Palace has been trying to really make the best out of a bad opportunity. They try to pivot, move back to a drive-in model. When we were able to go outside after the movement days, after curfews, or through use of the ENDS program that the government had out to try and provide the driving theater experience, which they got from a 2-year lease with Victoria Mutual. But that has since, ended. They closed out that operation, right? But in terms of the universe, what's actually affecting Palace Amusement and theaters in general, we are moving away from that model in general. So, for example, the US box office numbers in 2019 to 2021 would have moved away from like $11 billion to about $3 billion. So it is declining as people get more and more in tune and in touch with their home entertainment systems, right? I'm sure you all have Netflix or HBO Max or any other providers. And the movie producers and the other distributors of that are making notice of that. So you're going to be having a lot more of, say, Netflix originals, HBO Max originals, Disney Plus originals. And this is going to be affecting the amount of movies that are aired there, unless you're going to have a proper blockbuster or some content that has a real ground or basis within people's interests. You're not going to be having a whole lot of sold out movies that Palace might be looking for, right? So it's going to be a bit difficult for them. One of the things that they actually have managed to do that I noticed really well over the course of the last financial year for them is that their film rental services, where they actually do purchase or rent out film properties and distribute them to other Caribbean islands, actually did really well for them, to the tune of about 31% of their revenues over the course of that 2021 year, right? Which is actually more than all of the food sales put together. It's typically right there behind Carib 5 in terms of revenues that it provides for the company. So it's a great model for them. And if they do want to pivot a bit further, I think that's something they could really lean in on to continue bringing in some money. In the meanwhile, while they try and figure out the situation more. But as it is right now, Palace does have a lot of work to do if they really want to gather up the more and more patrons, right? So as you move on into the next slide, we can see what exactly that looks like illustrated. So prior to the fourth quarter of 2022, the last profitable quarter for them was the first quarter of 2020, right? And since then, they've just had a series of greater and greater losses. They have returned as much for the most recent quarter for them, but without some real driving factors for them, then it's going to be a little bit more tricky. I realized they did something pretty interesting as well when they really were taking note from a lot of the viewers and listening to what they had to say and their feedback. So they're even trying to appeal to the anime community over the course of this year. Probably that's something I can continue to look into. But as I said, that's all due to different factors that are going to be changing as things go along, right? Next slide, you'll see the stock price history has been trending down since about the end of June 2021. Before that, I had a nice, decent spike. So kudos to the investors who would have made that play and it would have paid off for them. But since then, it has been pretty much down, and without any proper indication that they're going to be returning to profitability consistently. Palace does. It's not one that I would recommend at the moment, right? But it is there is work to be done, and it's something I can definitely look into. Dan, anything to say?
Yeah, Justin, I think we're aligned on this one. This one's a definite sell for me. The future
It's a
is
sell.
not bright for Palace Amusements. I think the market's just moving in a different direction with the streaming and the many other
Yeah.
options, quite frankly. That upside down graph says it all. I mean, 8, 9, 10 quarters of negative earnings. And so when they're not running at full track or they're closed down, they have huge costs they have to carry. They now have a large amount of debt. And I just think it's a dying industry, quite frankly. So I think Netflix and these different streaming things are the way of the future. And for those who can't afford the Netflix or the streaming, I don't know if going to the theaters is a cheaper option. Actually, it's actually quite expensive to go.
It kind of is, especially when you look at the cost for the food. If you're going to be there for a couple hours, transportation. As we get more and more away from people having a lot of discretionary spending and things like that, it's
I think it's easier to have a Netflix party, quite frankly. So this one, unfortunately, folks, for me is definitely a sell. But I wish them all the best, and obviously I'm going to come back and look at how they perform over the next 12 months and how they're going to dig themselves out of this hole with all of that debt. But definitely not a buy for me. This would be a sell if you happen to have it. And it doesn't trade with great liquidity either. So this is not one you can buy $1 million worth of Palace today and sell it back in 6 months' time. So definitely be careful of this one, guys. But we'll have more to come. Well, to our viewers, thank you for all being a part of today's Investor Update. I'd like to go special thanks to my fellow panelist, Justin, for his invaluable insights and contribution, as always. Thanks, Justin.
Always glad to be here, man.
We urge viewers to follow us on social media to keep up with all things forum related. This includes guest speakers and more. Don't forget to subscribe to our YouTube channel, Mayberry Investments Limited. Thank you all for tuning in today and being a part of our special program. And remember, wise investors, slow and steady wins the race. Goodbye.